In 2000, Enron was America's seventh largest company, worth $70 billion. Fortune magazine called it America's most innovative company for 6 consecutive years. Just 1 year later, it was bankrupt and its executives were in handcuffs. This is the story of the biggest corporate fraud in American history, a scandal so massive it changed how businesses operate forever. The beginning. Enron started in 1985 when Kenneth Lay merged 2 natural gas pipeline companies. It wasn't flashy, just a traditional energy company moving natural gas through pipes across America. But Lay had bigger ambitions. In the 1990s, as energy markets were deregulated, Enron transformed itself. Instead of just moving gas, they began trading energy like stocks on Wall Street. They created entirely new markets, trading electricity, broadband capacity, even weather derivatives. If you could imagine it, Enron would find a way to trade it. The Golden Boy. Leading this transformation was Jeffrey Skilling, a former McKinsey consultant with an aggressive vision. Skilling believed Enron shouldn't be a stodgy energy company. It should be a trading powerhouse. He recruited the brightest graduates from top business schools, created a hyper-competitive culture, and promised investors double-digit growth every single quarter. By 2000, Enron employed 20,000 people. Its stock price soared from $20 to $90 per share. Executives were becoming millionaires overnight. Kenneth Lay hobnobbed with presidents. Jeffrey Skilling graced magazine covers. Andrew Fastow, the chief financial officer, won awards for his financial innovations. Everything looked perfect. But beneath the surface, Enron was rotting from the inside. Mark-to-market accounting. The fraud began with something seemingly boring: accounting rules. Skilling convinced regulators to let Enron use mark-to-market accounting for its trading business. Here's how it worked. Normally, companies record revenue when they actually receive cash. But mark-to-market accounting allowed Enron to book the projected profits from long-term contracts immediately, even if they wouldn't see actual money for years or ever. Imagine you sign a 20-year contract you think will make $100 million in profits. With mark-to-market, you could book that entire $100 million today. Stock price goes up, executives get bonuses, investors are thrilled. There's just one problem. What if those profits never materialize? Enron became addicted to this game. They'd sign questionable deals, make wildly optimistic projections, book massive profits, and watch their stock price climb. When deals inevitably underperformed, they'd hide the losses and sign even bigger deals to cover the shortfall. It was a snowball rolling downhill, getting bigger and more dangerous. The special purpose entities, but mark-to-market was just the beginning. CFO Andrew Fastow created something far more sinister, a web of shell companies called Special Purpose Entities, or SPES. These entities had innocuous names: Chuco, JEDI, LJM1, LJM2, Raptor. Their purpose was simple: hide Enron's debt and inflate its profits. Here's how the scheme worked. When Enron made bad investments or accumulated debt, they'd sell those assets to one of Fastow's SPEs. The SPE would buy the assets using money borrowed from banks, with Enron's own stock as collateral. Enron would book a profit on the sale, and the debt would disappear from Enron's balance sheet, moved into these off-the-books entities. It was financial wizardry, except it was all smoke and mirrors. Fastow personally made over $45 million from these partnerships, a staggering conflict of interest. And the entire structure was a house of cards built on Enron's stock price. If that stock ever fell, everything would collapse. The culture of deception. The fraud succeeded because of Enron's toxic culture. Skilling implemented a brutal rank and yank system. Every 6 months, employees were ranked, and the bottom 15% were fired. This created an environment where nobody dared question questionable practices or deliver bad news. Employees who raised concerns were sidelined or pushed out. When one executive questioned the SPES, Fastow told him to keep quiet or face consequences. The company's own lawyers and accountants at Arthur Andersen either didn't understand the complexity or chose to look the other way. Arthur Andersen was earning $52 million annually from Enron. Executives lived lavishly while lying to everyone. They threw million-dollar parties. They bought mansions and yachts. And when they started suspecting the end was near, they began selling their own stock while telling employees and investors to keep buying. The unraveling. The first crack appeared in August 2001 when Jeffrey Skilling suddenly resigned as CEO, citing personal reasons. Wall Street was confused. Why would the architect of Enron's success suddenly leave? Then came Sharon Watkins, an Enron vice president who sent an anonymous letter to Kenneth Lay warning that the company would implode in a wave of accounting scandals. When Lay did nothing, she identified herself and urged him to come clean. He dismissed her concerns. In October 2001, Enron reported a $638 million loss and a $1.2 billion reduction in shareholder equity related to the SPES. Investors panicked. Questions multiplied. Stock analysts who had rated Enron a strong buy for years suddenly started digging deeper. On November 8th, Enron admitted it had overstated earnings by nearly $600 million since 1997. The stock went into freefall. Credit rating agencies downgraded Enron's debt to junk status. Business partners refused to trade with them. The death spiral had begun. Bankruptcy and aftermath. On December 2nd, 2001, Enron filed for bankruptcy, the largest in American history at that time. 20,000 employees lost their jobs. Many also lost their life savings, as their 401k retirement accounts were heavily invested in Enron stock that executives had assured them was solid gold. Meanwhile, those same executives had cashed out hundreds of millions in stock while the company burned. Kenneth Lay sold $70 million worth of stock while telling employees the company was in great shape. Jeffrey Skilling sold $66 million. Andrew Fastow pocketed his $45 million from the partnerships. Arthur Andersen, one of the Big Five accounting firms, was convicted of obstructing justice for shredding thousands of Enron documents. The firm collapsed, putting 85,000 people worldwide out of work. Justice and legacy, the trials. The criminal trials were dramatic. Andrew Fastow pleaded guilty and testified against his former colleagues, receiving a 6-year prison sentence. Jeffrey Skilling was convicted on multiple counts of fraud and conspiracy, receiving 24 years in prison, later reduced to 14. Kenneth Lay was convicted on 10 counts of fraud but died of a heart attack before sentencing. His death vacated his conviction. Other executives received sentences ranging from 2 to 5 years. In total, 16 people were convicted. The reforms Enron shocked America. How could this happen? Where were the accountants, the regulators, the board of directors? The scandal exposed massive holes in corporate oversight. Congress responded with the Sarbanes-Oxley Act of 2002, the most sweeping corporate reform legislation since the 1930s. The law created new standards for corporate accountability, required CEOs and CFOs to personally certify financial statements, increased penalties for fraud, and strengthened auditor independence. Sarbanes-Oxley changed corporate America. Companies now have stricter internal controls, more independent boards, and greater transparency. Whistleblowers receive better protection. Accountants face tighter regulations. The lessons. The Enron scandal teaches us several crucial lessons. First, corporate culture matters. When success is valued above honesty, when employees fear retaliation for speaking up, when complexity is used to obscure rather than illuminate, disaster follows. Second, conflicts of interest are toxic. Fastow made millions from partnerships that hurt Enron. Arthur Andersen profited from consulting fees while auditing the same clients. These conflicts corrupted judgment. Third, complexity can be a red flag. Enron's SPES were so complicated that even sophisticated analysts couldn't understand them. Often, complexity is designed to confuse, not clarify. Finally, when something seems too good to be true, it probably is. Enron promised consistent growth in a volatile industry. Its profits seemed magical. Its executives lived like royalty. The warning signs were there. But greed blinded investors, employees, and regulators alike. The Enron logo once represented innovation and success. Today, it's synonymous with corporate greed and fraud. The company that called itself the world's leading company became a cautionary tale taught in business schools worldwide. 20 years later, the lessons of Enron remain relevant. Corporate scandals haven't disappeared, they've just evolved. But thanks to the reforms Enron sparked and the vigilance it inspired, the financial system has more safeguards. Enron's rise was spectacular, its fall was catastrophic, and its legacy is a reminder that in business, as in life, integrity isn't just good ethics, it's good business.